Okay, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be giving you an in-depth walkthrough of the straddle option trading strategy. So you're going to see how the strategy works, I'll discuss the pros and cons of it, and then I'll finally walk you through a few examples and scenarios. Now, very quickly before we get started here, as always, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, let's dive in here now. And what I have pulled up in this video is a 1-year price action chart of Nike. This company does have earnings next week, I believe on June 24th. And that's why we are seeing, as of right now, a pretty significant spike in implied volatility. Right, you can see currently IV is at just under 34%, which translates to an IV rank of 38% and an IV percentile of 63%. So definitely not bad. The IV for this stock is pretty elevated compared to where it usually is over the past year. And the reason why I'm pointing this out is because for strategies like the straddle, any option selling strategies, high implied volatility is absolutely crucial. And that's because when implied volatility expands like this, that's going to make the prices of all the options, both the calls and the puts, more expensive. And so of course, if the options are more expensive, it's going to be more advantageous to be selling them. So this is the first major thing you want to look for before placing a straddle. The second thing is you want to assess your directional assumption on the underlying stock. Now the straddle is a directionally neutral position, so ideally you just want the stock to bounce around in a nice tight range over the next few days and weeks. And in the case of Nike here, if I zoom in a bit, you can see that's basically exactly what's been happening. A lot of sideways up and down chop, a little bit of a downtrend in the process, but for the most part, pretty much just sideways price action. And so ultimately, if your assumption is this kind of price action is going to continue, then combined with high implied volatility, this would be a great stock for a straddle. And so now, what is a straddle? Let's come to the trade tab real quick, and we'll go into the July expiration cycle. These options expire in 27 days from today. And so the straddle is simply a combination of selling both a call option and a put option at the same time. And the thing that makes this a straddle as opposed to a very similar strategy called the strangle is in the case of a straddle, you're going to sell the at-the-money call option and also the at-the-money put option. So given that right now, as of the last market close, Nike is at $128.41 per share, very close to 130. So that means I would sell the 130 strike call option and also the 130 strike put option. Of course, these options are not exactly at the money. They're about $1.60 away from that. But of course, there is no strike for exactly $128.41. So just get as close as you can. So now I'm going to set up this order here so you can see how it looks. We'll go to sell and then down to the straddle. And by default, it brings up an order down here. Sell one contract, 130 strike call option, and then also sell one contract, 130 strike put option. And the total credit you would receive for putting on this position is just under $900. That's pretty nice. Now the major caveat with this position though is that you are almost never, and I should just say never, you will never get to keep the full credit on this position. And that's because in order to do so, in order to actually keep the full $900 here, you would have to exactly pin the stock on your strike price by the expiration date. So basically by July 16th, in 27 days, Nike must be at exactly $130 per share. And if that happens, then yes, you will get to keep and walk away with the full $897 here. But what are the odds of that happening? Basically zero. So again, the point here is not to try and keep the full credit. It is simply to keep as much as you can. So now let's go ahead and throw this position up onto the Analyze tab, and we can take a look at the payoff diagram for it. So I've shown this in a few of my other YouTube videos, but in case this is the first time you're seeing this, on the x-axis, this represents all the different prices that Nike stock could be by the expiration date or somewhere along the way. And then on the y-axis, this will show you the profitability of this position based on where Nike stock is actually trading. Now for the purpose of this video, just focus on this blue line here. This will show you the payoff or the profitability of this straddle by the expiration date, by July 16th. And these small red ticks right here and over here show you the break-even points for this straddle. So essentially, as long as by July 16th, Nike is somewhere in between about 121 bucks per share and 139 bucks per share, anywhere in this range, you will make some profit on this position. It might just be $1, it might be $600, but this is your zone of profitability. And that's why the straddle is a directionally neutral position, right? Because anywhere outside this range, you're going to lose money. So of course, like I said, you want the stock to be range bound. Basically just move sideways over the course of this expiration cycle. So next here, let's walk through a few scenarios so you can really see and understand how this position works. And to help make the math a bit easier, let's just round down the current price of Nike down to exactly 128 bucks per share. And then for the credit, let's just round this up to a nice and even 900. So in our first scenario, let's say we put on this position right now, and then by July 16th, by the expiration date, Nike falls in price from 128 down to 123, let's say, a full $5. So in this case, our call option is going to expire worthless, right? Because at this point, Nike would be below our call strike. But for the put option, this put option would be in the money. And so I'm going to get assigned on this contract, which in the case of a short put option means I have to buy 100 shares of the stock at the strike price at 130. So let's go ahead and pull up the calculator here. I'll move this right there. So like I said, once I get assigned, I have to purchase 100 shares of Nike at a price of 130 bucks per share. So that's of course going to cost money. And then once I have those shares, I can then immediately turn around and sell them at the current market price, which in our example is 123 bucks per share. So this will create a loss of $7 per share times the 100 shares we're dealing with. That's an overall loss of 700 bucks, at least just on the stock. But don't forget, we initially took in 900 bucks in credit. So now I add to this 900, and in the end, that leaves an actual profit of $200. So again, just to reiterate here, the goal is to keep as much of this credit as possible. And in this case, we got to keep 200 bucks of it, and we lost the other 700. But we still made a profit nonetheless, and that's a good thing. And now for our second scenario, let's say the opposite occurs and Nike skyrockets by the expiration date. And perhaps it goes from 128 all the way to 140 by July 16th. So now in this scenario, our put option will expire worthless because it's out of the money, but the call option will be in the money. So we'll get assigned on this contract. And for a short call option, when you get assigned, that means you have to sell 100 shares of the stock at the strike price. Now I'm assuming here that we do not already own 100 shares of Nike before we sold the straddle. Otherwise, this would be a covered call option, and that's for a separate video. In this case, we are selling totally naked options, and we have no shares of Nike stock in our portfolio before placing this straddle order. So that means before I can honor my agreement on this contract and sell those shares, I have to first buy them. So I'll have to go into the market and buy those 100 shares at the market price of $140 per share. And of course, that will cost money. And now once I have those shares, I can honor my agreement on this contract and sell them at a price of $130, which creates a net loss of 10 bucks per share times the 100 shares. That's an overall loss of $1,000. But finally, I can add to this the 900 bucks we took in initially, so plus 900, and in the end, we actually lose 100 bucks on this position. Not a big deal, but still a loss. So that's how this position works. If you hold the straddle all the way to the expiration date, you will get assigned on one of these contracts. Because simply by the nature of this strategy's construction, by selling two contracts with the exact same strike, one option will always be in the money, and one option will always expire in the money. Now, of course, you can close this position before the expiration date to avoid assignment, but again, if you do hold it all the way through expiration, you will get assigned on one of these contracts. And that's not a big deal. It's not an issue. It is simply something I want to raise your awareness around. So in a nutshell, that is the straddle option trading strategy. It is a directionally neutral position that takes advantage of high implied volatility and sideways price action. And also, it does come with a pretty high probability of profit. It may be impossible to make the maximum profit on this position to keep the full credit, but you still have a pretty high chance of making some profit on the trade. And that's because, once again, you have this whole entire price range for Nike to move around in to still make some money. And if you want to calculate your break-even points exactly, all you have to do is take the credit you receive for putting on the position, and then you add it and subtract it to the strike prices of your contracts. So real quick here, let's bring the calculator back and let me move this down here. So for our break-even point on the upside, we simply take the strike price of our call option, which is 30 bucks, and then we add to that the credit we receive, which is $8.97 on a per share basis. So that means our break-even point on the upside is $38.97 per share. If Nike trades above this price by July 16th, then at that point, you will start to lose money overall on the position. And then for the downside, we take the strike price of our put option, which is again 30 bucks, and now we subtract from it the credit we receive, so $8.97, and there you go. The break-even point to the downside is $21.03. Anywhere below this point by the expiration date, you will start to lose money overall on the position. But as you can see here on the charts, 121 is all the way down here, well below this entire range over the past 12 months or so. And then 139, just rounding up a little bit, is all the way up here, right at the peak of this short-term range. So just wanted to give you a visual sense of how wide this range is, how wide your profitability zone is, just to prove that this is still a very high probability of profit position. It definitely carries a lot of risk with it because, again, one of your options will always be in the money. And if Nike really moves, either to the upside or the downside, you could have some pretty nasty losses. But with bigger risk comes bigger reward. So if you are correct and Nike pretty much goes nowhere by the expiration date, you'll have a pretty big payout. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.